Before we begin, we would like to set the scene by sharing the survey results that Bloomberg Intelligence did late last year of senior private bankers based in Hong Kong and Singapore. So on the screen there, you'll see that the responses where their clients are expected to allocate AUM by asset class over the next 12 months. And it's led by equities, which is in line with what Your Highness Prince Max said at the very beginning, followed by private equity closely and digital assets as well as hedge funds. So it is quite clear that family offices and private wealth clients in general do think that these are very important asset classes over the next 12 months. So with that, last year was quite a while ago, and since then, we've had the war in the Middle East, and not only that, but also the concerns that we're seeing in the private credit space, right, with rising defaults and the redemption requests. So with that, we would like to poll the audience quickly, where you can scan that QR code. We would love to hear your thoughts in terms of the asset classes that you are preferring. So the question is, what are your top 3 most preferred asset classes over the next 12 months? And we'll leave the code up there for about 10 seconds, just to give everyone a chance to scan. Yep, and so far we have the early results in. So yep, it still looks like it's equities, followed by gold and precious metals, right? That does make some sense with what we're seeing in terms of volatility. Private equity catching up. So maybe we can kick start now. Christina, did these results surprise you?
Well, thank you, Sharnie, for having us, and thank you to Bloomberg for inviting Morgan Stanley and for inviting me to share some thoughts at this very important Family Office Summit. In terms of the survey results and what we're seeing here, particularly as it relates to alternative investments, yes, broadly, I can resonate with that amongst the Asian family office clients who we're interacting with. Certainly, family offices, particularly in Asia, are no longer chasing just deals. They are moving towards investing and building portfolios with intent and creating investment-led platforms, whether that's with in-house expertise or very closely aligned expertise to build those formalized frameworks for investing that incorporate alternatives with particular regard to private equity and hedge funds. And that certainly as an asset class we've seen building out over the last few years and becoming a concerted effort in terms of a meaningful asset class in investment portfolios.
Right. So, Elton, in our earlier chat, you mentioned that VMS has tried to steer clear from private credit. And actually, there's negative headlines, every day recently. But at the same time, you're much more bullish on the private equity space. Right. But having said that, there's slower exits. The IPO market's actually slower globally, with the exception of Hong Kong, which Secretary Paul Chan just talked about. So can you talk a bit about your contrasting view on private credit versus private equity?
Sure. Well, thank you, Sharnie, again. Pleasure to be here. Maybe I'll rewind a little bit and just go back in history before I mention what we are doing now or projecting in the future. We've been working with families in Hong Kong and in the region for the last 20 years, so we've ridden some cycles with them. And also we've seen the preference in terms of appetite and where to take risks and where to allocate. We actually rewind back to around about 2015 to 18 or so. We are actually allocated quite a lot for some of these families into private credit. And because and a lot of those investments are real estate related. And so we saw the leverage level of the companies that we lend to going up, and then we see the risks coming in, and so that's why we pull back. So by about 2018, we cut the exposure for these families down to basically zero. And we've been watching since then to see whether we would want to go back in the space, and partly because we've disbanded the team, so we don't have the team, the expertise to look at it quickly. And so we've been watching on the sideline, and it's kind of in a way lucky that we haven't gone back into the private credit space. So in some ways, there's some peculiarity in terms of what we are doing with our clients. But then as far as private equity is concerned, again, we've been in the space since the beginning of the firm, which is 2006. So we've been, again, looking at different cycles. But the latest vintage of investments that we help families allocate, like around about COVID time, 2019, 2020, it's exactly the vintage that we talk about. We're not seeing exits. We're not seeing DPI. Of course, I mean, with the IPO market, including particularly in Hong Kong, we heard that 300 companies waiting list. A few of those are the investment that we have positions in. So it's good news. So exits are coming, but then at the same time, we are also hearing during that vintage when we are kind of increasing our allocation to private equity, that we're hearing from the families say, hey, yes, the deals are performing, the funds are performing, but at the same time, because we're not seeing exit, and then again, some of the families that we work with, they might also have their own liquidity concern to say, hey, the next investments that we want to put more allocation into should be more liquid compared to private equity, especially while we are seeing, of course, again, the pipeline 2026 probably quite positive, but we can't just sit here and wait for the DPI and wait for the exit and not do allocations, right? So that's why in the last 2 to 3 years, we've been talking to our family clients about more liquid strategies, including in particular hedge funds. So we can talk more about hedge funds, but we finally, for us at least, we built some capability to look at that asset class instead of being very concentrated only on the illiquid private markets.
Right. And on the topic of hedge funds, Matthew, family offices are increasingly allocating to hedge funds. Can you explain, what is driving that interest?
Maybe before I talk about hedge funds, first of all, thanks for having me. Thanks for this great event today. Before we talk about the hedge funds, I just want to make a quick comment on this survey, right? Everything but alternatives are liquid asset classes, and it's easy to rebalance your portfolio based on market sentiment. And if you look at, for example, digital assets today, they rated at 10%. I think your survey before of last year, of 12 months ago, they were one of the highest asset classes in terms of interest. But it's easy to divest out of the asset class. When it comes to hedge funds, when it comes to private equity, when it comes to private credit, it's a very, very different story. And I want to bounce back on one comment that Christina made earlier, which is, first and foremost, you need to think about your 5-year horizon or your 10-year horizon. What is your strategic asset allocation? What kind of risk are you willing to take? What kind of liquidity needs do you have? And therefore, what is your core allocation? And then you can make adjustments based on market sentiment and your views. But one thing that has been, I think, missing, and we're seeing increasing sort of focus on that, in that region has been a more institutional way of looking at asset allocation, and in particularly when it comes to alternatives, right? I mean, again, you cannot get out of your private credit or your private equity allocation overnight. Now, when it comes to hedge funds in particular, it has been a beneficiary of this trend of institutionalizing portfolios. They have benefits, again, and the audience probably is aware of those. Today, if you build a relatively well-diversified hedge fund portfolio, you're probably going to get bond-like returns with probably half the volatility. So they have benefits at the expense of liquidity. I mean, everybody, there's no free lunch in finance. But they have been a beneficiary over the past 3-4 years of this vision family offices have today of being better asset allocator to start with, before taking a bet on whether equities are going to outperform over the next 12 months or not. So that's really what we've seen over the past, I would say, few years.
Right. And what are some of the most popular strategies that you're seeing in the hedge fund space?
So if I continue my theme, right, hedge funds, maybe say 10, 20, we've been investing in hedge funds since 1989, so we've seen quite a few cycles. But I would say over the past 10, 15 years, post-financial crisis, really, hedge funds have been much more disciplined in risk management. And the benefit of that as well, today is that you don't necessarily compare your hedge fund returns to equity returns. You actually compare your hedge fund returns to a bond portfolio, because you can achieve high single-digit returns in a much less volatile asset class. Again, as I mentioned earlier, at the expense of liquidity, these hedge funds tend to be less and less liquid. And the biggest beneficiary within strategies of that are actually not a strategy, but it's the multi-manager, multi-strategy platforms. They've been big beneficiaries of allocation of family offices and high net worth individuals. Why? Again, because they provide that sort of sleep well at night type of returns, highly diversified, and have sort of a fund of hedge funds 2.0 effectively in the way they're set up today. So that has been the biggest beneficiary. And then again, as I said, right, then what we advise clients first and foremost is make sure you're diversified and your hedge funds have allocate across asset classes, whether it's long short or cross strategies, whether it's long short equity, macro, et cetera. But obviously the biggest beneficiaries have been these multi-strategy platforms.
Right. And Elton, you mentioned earlier that you're building in-house hedge fund capabilities, versus relying on institutional platforms. Can you talk about your thought process on that? Like, why are you bringing it in-house?
Sharnie, why are we bringing it in-house? Well, frankly, we've been thinking about building that sort of capability for the last few years. Again, given we're capital driven, the families want to find more liquid investment, and hedge fund is an asset class they're interested in. And so we need to find the right talent. We find the right talent, and then generally we're agnostic about whether we do it in-house or partnering with someone externally. We found a team, and then the dynamics of the team is such that they are happy to do it in-house. Within our VMS brand name, then of course, naturally, we're happy to have a VMS branded strategy or platform. And then again, echoing what Mathieu was saying, it's we want to build a multi-strategy, multi-manager hedge fund strategy. So instead of just us say, oh, I find a portfolio manager to build an equity long short strategy, whether it's Asia, China, or across the world as a single strategy, we want to build something multi-strategy. And so, of course, I mean, the attractiveness of that sort of strategy is ultimately you're talking about, again, maybe bond-like or hopefully slightly better than bond-like return, but ultimately low volatility, low drawdown, because you're talking about the mixture of the strategies having lower or even no correlation to each other. So that is a more all-weather strategy, be it whether it's a fund of fund type strategy or fund of SMA type strategy across different. And the focus we're looking at is potentially more Asia focus. Again, we believe in letting the experts do what they're good at. So while we are sitting here, while the team we're building, while the ecosystem we are in the hedge fund world is within Asia, it will be harder for us to stand out by saying that we can select the best managers, let's say in the US or some other parts outside of Asia. If we're here, we look at a more Asia-focused strategy. And again, a lot of families are quite under-allocated in the hedge fund space, so that's why we want to do it, and we have the capability, so we do it in-house. Right.
And Christina, I want to talk about Evergreen funds. Actually, this morning in the on top news, there's talks of redemption requests, over 11%, but it's now being gated at around 5%. So I guess, what are you seeing in this space? Do you think that these structures are still going to be very popular? And ultimately, privates are illiquid by nature, right? So can you talk about just the attraction of Evergreen funds?
Sure, certainly. So let's take a step back. Actually, perpetual structures have been around for years, and particularly in respect of family structures, the perpetual fund is able to provide a continuous stream of capital for investments that don't necessarily need or have to have an imminent exit and can be compounded over generations. And actually families, particularly Asian families with operating companies with real assets underlying, are very au fait with these type of structures. Now, the more recent Evergreen structure that offers periodic liquidity is, of course, attractive in an environment where private equity returns have moderated and where the exit environment has slowed. So there is a nuance to be taken to this asset class. There are certainly areas of the market are more suitable for more locked up vehicles, and there are certainly areas of the asset class that continue to be well placed in an evergreen structure. What we will see is, besides the asset class or besides the access to underlying private markets continuing to remain structural through perpetual structures, what I think that we will start to see is some thought around the design as it relates to investor targeting and as it relates to liquidity offers. And that is similar to what we've seen that the hedge fund community go through the financial crisis in terms of thinking about how they offer periodic liquidity.
Right. And what are some of the risks and pitfalls for family offices investing in these evergreen funds?
Have to think about the mismatch in terms of the underlying markets, and that doesn't necessarily mean that just because the underlying market is private or that the underlying asset is not expecting to IPO very soon, that it's not appropriate for an evergreen structure. It could well be appropriate if the overlaying redemption terms are very much laid out, very much clear to the end investor, and well communicated throughout, and everyone's interests are aligned in that regard. So it's just ensuring that you as an investor, you understand the paperwork, you understand what those structures are designed to do. Gates are ultimately there to protect the existing investors and function as they should. And we believe that as long as you are very well understanding in terms of those terms, then you are in a good place.
Right. And turning to co-investment opportunities, Mathieu, we also heard Secretary Paul Chan mention this. Can you talk about what you're seeing with the families that you're working with?
Again, I want to comment on the last question.
Oh, okay, sure.
Just to echo a little bit what Christina is saying as well. I think private markets are illiquid in nature. Whatever the vehicle we are using to invest in private markets, they remain illiquid. I think that's the one thing that we should all remember. And we've been, as HSBC, we've been early adopters of these structures. We grow our shelf of products about 3 years ago to what is today a pretty extensive offering. But we were also big advocates of moving away from the word semi-liquid. And I'm glad to hear from you that you call them evergreens now. But remember, 3 years ago, they were called semi-liquids. The benefits of those structures are not the liquidity. We're not creating liquidity by having those structures, and we should move away from that narrative. The benefits for investors, to Christina's point, is you don't have to deal with the complexity that is associated with closed-ended funds. You have to manage capital calls, distributions, re-ups, diversification by vintage, diversification by manager. It's a nightmare unless you are a well set up, large family office or an institution. And again, the two structures can also coexist. There are strategies that can be better suited for evergreens. There are strategies that will never be suited for evergreens, right? But fundamentally, I think the whole industry, the media, everybody has to move away from this concept of liquidity. We have not created liquidity with those products in private markets. That's not the purpose. The purpose is convenience and allowing more people to access what we believe is an asset class that is helpful for investors in the portfolio. Going back to your question on co-investments. Co-investments are interesting. I think everybody wants to have access to co-investments. We hear a lot of family offices, especially the larger ones, that are keen on accessing co-investments. But that's true for family offices, and it's true for the largest institutions out there. And the question becomes, how do you access those co-investments? And that's where people should remember that you may be a large family office, you may be large by standards of private individual wealth, but are you large by standards of an institutional landscape, right? When you are competing for co-investments with some of the largest institutions out there, right? And that's probably the number one question you should ask yourself, right? Is, am I really relevant for the GPs I'm going to try to approach to get access to the best co-investments? Because the last thing you want is to be last in the queue, right? When everybody else has passed on the co-investment opportunity, you get the call. So that's really the number one question you should ask. Obviously, size matters, but also obviously your access, your relationships, maybe the value you can bring to the GPs. But that's really, really important. We at HSBC have got a very large private markets platform because we invest not only on behalf of our clients, but also on behalf of our own institutional capital. We run large insurance companies. You see HSBC Life here in Hong Kong being the largest insurer in Hong Kong, life insurer in Hong Kong. And these institutions within HSBC Group are allocating to private markets. So when GPs talk to HSBC, they see a pretty large pool of capital that can allocate to asset class. So we've been developing structures to help family offices co-invest alongside us in the co-investments that we do.
Right. And you mentioned strategic relations. And on that note, I'd like to ask Christina about the importance of strategic relations.
Yeah, strategic relationships are increasingly determining outcomes for alternative investments as it relates to Asian families. We know that Asian families have long loved access to co-investment opportunities. Now we're seeing Asian families wanting to take co-GP roles or LPAC roles together with their GPs for increased influence from a governance perspective or to have better insights into the portfolio companies that they are investing with. Similarly, on the hedge fund side, we're seeing much more active participation in managers. Asian family offices are very happy to seed new managers and new strategies or take significant stakes or become strategic shareholders with hedge fund managers in order to have a better understanding and better transparency as it relates to those strategies. So building those alternative investments across the hedge fund space as well as the private market space is becoming increasingly informed by the ability for those families to generate long-term strategic relationships.
Right. And actually, on that note, can we just pause for a while? We would like to share the poll results with the audience. It's okay? Great. So this is what we have. Equities coming out top, followed by gold and precious metals, then private equity, then hedge funds, which is in line with what we expected. Now, cash and money markets, that's now number 5, so much higher. And then digital assets has pretty much dropped to close to last. So that's pretty interesting. So on that note, Mathieu, what do you think about the results?
First of all, again, if you're a family office and you're investing long term, I think cash is the worst place to put your money. Eventually, a diversified portfolio will always do better. That would be my first comment. And I would come back to my point earlier, right? 90% of your returns eventually on a long-term basis come from a well-diversified structured asset allocation. Make sure you spend the time, the money, the resources to construct this. I think this is what eventually brings most of the returns, because otherwise you can move based on noise and lose the sort of long-term sort of North Star that you've set for your family or for your investment portfolio, right? So for me, that's the most important. And if you think about asset allocation, I'm sure cash is the best place to start.
Yeah. So let's turn to Asia. Family offices in this region do tend to be relatively underallocated to alts versus global peers. Christina, can you talk a bit about what is different in this region?
We are still in the relatively early innings of Asian families building institutionalized frameworks whereby alternatives makes up a meaningful part of that portfolio. We've moved from the pursuit of outright outperformance and concentrated bets to building portfolios with very clear objectives as to what each bucket is designed to achieve from a risk-adjusted return perspective, and that is going to help to build that alternatives allocation. But also, our global peers function within a much more rigid framework of asset allocation, whether it's due to governance or tax restrictions. We in Asia, Asian families, are able to retain a degree of flexibility even when you've built out your very clear and concise asset allocation portfolio. And the beauty of this is that Asian families are able to be both under and over allocated to alternatives at times, and are able to deploy both more institutionalized as well as entrepreneurial capital. Whereas our peers globally have been compounding alternatives exposure over time. Some of that delegated decision making has been sitting there for a long time, compounding over the generations and not moving in and out so much. So you may have seen that we are now sitting in an area where the exposures are a function of a much longer term exposure deployment, whereas in Asia we're still building that. But certainly I've seen times where we are over allocated in alternatives in the region, and we'll continue to see pockets of that to come.
Yeah, so it's actually an exciting time to be here, right, in the alt
Absolutely.
space. So earlier today, we heard a lot about the risks, the geopolitics, the private credit defaults. So, Elton, I'd like to ask, do you see risk tolerance shifting for family offices? There's clearly a lot of patient capital, so it might be different. So, has behavior changed?
Well, so far, I guess, it may be a cliche to say that. There's a saying about the only certainty in life is uncertainty, right? So we've been living in a world of uncertainty and increasing uncertainty, especially with what's going on in the Middle East. But we haven't, I guess, the early stage for us, we haven't seen actual shifts in the families that we work with in terms of, their appetite or their risk tolerance. They say, let me take some out of this pocket and move to it. We haven't seen that yet, but we're projecting that, especially if that uncertainty and the conflict continues. There will, I guess, this survey we're looking at, the gold and precious metal being the second, right? The second pocket. I think that's an indication already. But then, talking about going back to the two asset classes that we're quite focused on today in the alternative space, private equity, hedge funds. Again, if I spend maybe 2 minutes to talk about hedge funds, I'm not saying that we anticipated it, but number one, in times of uncertainty, liquidity is important. So especially we're facing off with some of the families where they are saying, the private equity the exits is slower to come, and hence they want the next investment, they want something more liquid. Hedge fund is a good space for them to look at. And again, that space, we can talk about what sort of strategies, but the diversified multi-strategy portfolio, it's something that we see increasing appetite for it. Because, again, apart from there being liquidity, number two, it's more all-weather. Again, in this sort of environment, it's suitable. The other theme, again, maybe you go back to private equity, we can't escape the discussion about the AI competition. The two largest economies in the world, they are having the AI race. So allocation to that AI space, we cannot ignore. And in the private equity space, whether you're talking about very early stage VC investment or not, that's a space that we are continuing to see a lot of people wanting to have allocation. Whether you're talking about the big names of the world or the emerging AI, including in particular AI infrastructure. One name that we're very focused on looking at and the sector is energy related, because AI, especially when you're talking about the age of agentic AI, they suck a lot of energy. So what's the new source of energy that we're thinking about that is renewable, and you can continue to get the source? Nuclear is a source. So I'm not talking about now I'm moving towards maybe going off a tangent, not so much about risk tolerance, but it's more about what are some of the themes that emerge in this sort of environment, the geopolitics, the AI race. So these are some of the things that we should watch. These are some of the ideas that we have. Yeah. And we hear, again, it's not just us, not that we have a particular house view, but talking to the families that we work with, these are some of the things that are in demand.
Yeah, there's still clearly a lot of opportunities out there. So I guess from a governance and structuring standpoint, how are the families managing these risks, Matthew?
I'll make two comments on risks, right? What we've seen is we've got a partnership with BlackRock. We use their Aladdin engine for risk management for the clients that want to have a risk management framework. And clearly the adoption from family offices here in the region has been increasing very, very steadily. To come back to a comment made earlier, right, I think the chase, I guess 10, 20 years ago, the story was, sitting here in Asia was relatively clear, right? There was significant growth, a lot of opportunities in the region. Today, the markets have changed, and diversification and management of the risk is a lot more top of people's mind, right? So managing the risks in a much more professional way is certainly something we're seeing, and we're seeing this through adoptions of some of the tools, for example, with our clients. The second thing, the second comment I want to make is, one of the greatest investors out there, Warren Buffett, he's got a famous quote that I'm sure everybody knows, right? Be fearful when everybody's greedy, and be greedy when everybody's fearful, right? So, let's take private credit, because everybody's talking about private credit, and it's the least favored asset class, or one of the least favored asset class, right? At the end of the day, selection of the managers is what's going to matter the most. There are going to be people out there that are going to make a lot of money out of the situation, and there are going to be people out there that are going to be seriously impacted by what is going on and by the credit cycle. No doubt about this. Diversification in the manager performance is going to be a lot more than what we've seen in the past few years. And again, the way we underwrite and the way we select those funds, and we talked about evergreens earlier on, we select them the same way we select a closed-ended fund. When you select a closed-ended fund for a client, you are making a commitment to a manager for 10 years. You are betting on the ability of the manager to invest the money, whether the cycle is a good cycle or it's a bad cycle. And if you take the same view for evergreens, in an environment like today, if you trust your fund selection process, you actually stay in, because you believe the manager is going to come out strong out of the situation. So again, in terms of risk management, and in your situation, when in these moments like today, think about fund selection, think about whether you have the right infrastructure and the right governance and the right access to find the best manager out there.
Thank you. And the red light is flashing again. So thank you to all our speakers. Can we put our hands together for them? Thank you.